Okay, Byron, here we are. I don't know how long ago did we meet?
I don't know. It was like almost a year, maybe.
Almost a year ago. And now ink is dry. We've actually officially done a close on our fund two, and we thought it would be good to get together and talk about kind of the journey of evolving kind of your model, which I had come across in a white paper that you had written, to something that fit us. So maybe we dive in, give us kind of a quick intro of you, what you've been up to, and kind of the Fenwick fund practice.
Yeah, thanks. I appreciate the idea of coming and having this conversation. So I'm Byron Dailey. I'm a partner at Fenwick and West. It is a law firm that focuses on the high growth venture backed startup ecosystem. That's all we do. And I lead the fund formation practice. We focus on setting up venture capital funds and venture studios and other closely related things. And obviously we're here to talk about the venture studio stuff. And as you said, I've done previous podcasts and written some other materials on this. And that's what led to us meeting and sort of developing some new cool stuff. So tell me what's Gitwit and who's Jacob?
Yeah, so the Gitwit story. So I'm a co-founder of Gitwit, which started as an innovation agency that had everything from the discovery function to be able to go help companies do primary research, come up with insights, find ideas, validate them, build prototypes, and get them to market. So really all the functions of a venture studio, but we weren't originally a venture studio. We kind of accidentally became a venture studio. In fact, we had an investor who we had built a venture that we had self-funded, and they came to us and like, you should really build a venture studio. And we're like, those two words sound cool together. What is that? and it's actually kind of what ultimately led us to you, is because we raised this $8 million fund, which was kind of this sidecar to our professional services company. And we made some mistakes there. And that's really what led us to you, is because in that formation of that initial one, by year 2 or 3, I started to see some of the cracks form of what we had done. And specifically, our ventures didn't look like other ventures when they got to downstream capital. And that's really what led us to doing the research, reading through. That's when I stumbled across one of your white papers and found, here's somebody who has solved for that. So that's really kind of how our worlds came together, is when we were going into a fund two and deciding to go all in on this venture studio model and really divest the professional services. That's where I was like, we need to do this right. We need to find who has solved this. And so that's where this story picks up, I guess 9 months ago at this point, was with kind of you and what you had built in this Model A.
Yeah.
Which I think is a good starting point. So you want to take us through kind of actually before we talk about the Model A, how long have you been designing venture studios? Like, where's the first one? And then, how long ago
That's
was
a
that?
great place to start. 5 years ago, almost nobody was using the term venture studio. There were a couple that had been around for a handful of years, but they really started to pick up, more or less 4 or 5 years ago. But it is kind of a new thing, like in our world where it's dominated by venture capital funds and startup companies. Venture studios kind of started to emerge as like a different sort of building and investing model, where instead of, starting one company and focusing on it, or starting an investment firm that's going to pool capital to invest in those startup companies, you're going to kind of do both. You're going to pool capital in order to build a bunch of companies in your portfolio. So where you see a venture capital firm going out and pooling money from investors so that they can then deploy it into a bunch of pre-existing startups that are run by other people. Instead, you're pooling capital from a bunch of investors with the promise that, we're going to actually be the initial builders and co-founders of a portfolio of companies. And so it's a relatively new model. And 4 or 5 years ago, like I said, I was starting to see some strange things. I had started to see some, venture studios come across my desk. And I was scratching my head all the time because they were all the ones that I was seeing were poorly designed And I think what was happening was they were either getting designed by corporate lawyers, the kind of lawyers who would set up a startup company, or they were getting designed by venture capital fund formation lawyers.
Ours was the latter.
And yours was the latter, and that was really common, and both of those models were not really working well. They weren't optimizing for incentive alignment among all the stakeholders. They weren't optimizing for tax. There's so many great tax optimization opportunities in setting these up. And they weren't thinking ahead about, other things about future capital raising at the venture studio. And they also, as you noted, were tending to, especially when whether they were organizing more like a fund or more like a company, they were tending to create sort of ugly looking cap tables on the startups that were coming out of them, which was, really hamstringing those startup companies because you can have problems on your cap table that make it, so it's really hard for the company to succeed. And I came up with this thing that I called Model A, which eventually was what I thought was generally, the in most cases, the most useful, best model to think about when trying to decide how to set up a venture studio. And so some of the things that it tried to design for was, so let's focus on this idea of the cap table of the startup company, right? So
because that was a huge one for us, right? There was our team and our employees. That was one thing that we wanted to solve for, as well as I wanted them to be highly incentivized. In our studio, we ended up with 30% of the profits interest going to employees, not to partners, which we're incredibly proud of. But also, they are getting the same tax treatment as everyone else. And that was another thing I didn't like from the first way we had set it up, is our employees were going to get a different tax treatment than LPs and partners, and I wanted for our employees to have that. But then there was for the downstream capital, which was this one lump of equity on the cap table, and we had to continually justify what is that thing. And that became an incredible pain. And I think one of the things, as you walk through this Model A, bring this up on the screen over here, was this idea of it's storytelling as much as anything. Yeah,
and so in the startup world, venture studio incubated companies are notorious for having this problem where you've got one line item on the cap table that represents the studio's interest, and it's like 40, 50, 60%, and by the time you're raising Series A, the venture studio is no longer in almost all cases engaged in any real way with the company anymore. And later VCs who are looking to do that Series A fundraising see that, and they say, this is the wrong people are incentivized. The active co-founders, executive team are not adequately incentivized because you've got this big chunk that's owned by someone who's, they call it dead capital.
That's right.
Right. And so they're notorious.
Which is bullshit to begin with, but
it's true.
Whatever.
But and so that's where it kind of gets to the, not only was it creating like this problem, but it was not reflecting, in the best cases, it was not reflecting reality. And I when I looked at that, I thought there has to be a better way to do this that actually more reflects the reality of what a good venture studio brings to a startup that it incubates. And so, on the screen here, we see that we've got this set up so that there's going to be two initial stockholders of each of these startups. We're breaking this up into two pieces that reflect the reality here, where you've got actually in a studio, you've got two different stakes, one of which is there because the studio is a co-founder. The studio is not a venture capital firm, or it's at least not only a venture capital firm, because it's actually helping co-found these companies. And so therefore it should have a common stake, and that's the one on the left, that black triangle. And then if the venture studio is also deploying some investment dollars down into the startup, do that through the fund, and that's going to usually be a safe. And then you've got, 2 line items, and call them like 15 to 20% each. In many cases, it looks better, and it actually matches the reality. So you can, if a VC looks at the cap table of a company they're going to invest in, and they have who are these stockholders, you've got that story, and it's the reality, and it makes more sense.
There's a nuance that I think other studio operators should also know about this is when you're then deploying capital from your investors, this structure gives you the flexibility to decide what of it comes down through the startup and then back to the studio, and what of it goes straight to the studio. And that flexibility is really important in the storytelling part of this as well.
Yeah, you're talking about for how do we fund the operations of the studio? How do we pay the studio for the work that it's doing in the early stages of this? Yeah, and so this model, enables flexibility around there where, in the stage before you're creating the startup, when you're just working on ideas, whiteboarding, brainstorming, throwing away ideas, you need to pay a staff for that. Hopefully you can do that part leanly, but that's usually going to be represented by some direct, services, development, management fee paid by the fund to the studio operations entity, much like a management fee in a venture capital fund. And then, normally, after you are ready to spin out a startup, you create it, then you, put some money into it out of the fund. There's this model that's widespread and widely accepted called a chargeback model, where then for some period, the studio team is going to continue to either wholly or partly support the early growth of the company, and it should get paid for that. And it sort of works more like it's a consulting firm or an outside service provider, development firm, depending on what it's doing. But for that post spin out stage of it, some of those safe dollars that go down from the fund into the company can then be paid by the company back to the studio as a direct services fee. And that's going to be temporary while the studio is still working on the company.
But it creates this record. So for us, it creates this record on the cap table, and when you're showing somebody later, here's what was actually happening, right? Mm-hmm. We put money into this, and just as if this startup were to be paying a salary to a product designer or to a researcher or to somebody on the operations or strategy team. So to us, it told that story without us having to verbally do it to a downstream venture capitalist who's trying to they wouldn't ask those questions to a startup because the startup was just, paying money to these things. So to us, this structure really solved for that. And another comment I'll make, I was at an event in New York City, and they did a panel with venture capitalists asking them about investing in studio founded companies. And 3 different venture capitalists said the same thing in 3 different ways. And what they said is, what we want to know is that the team we're going to invest in, meaning not the studio team, the operating team, which we here call them operating teams. Right. Some people call them founding teams, but we're like, no, we're the founders. They're the operating team. So, And so that's one of the things that this does. Yeah. And it breaks up what's effectively the studio fund. In fact, we even named ours Archer Pre-Seed, right? We wanted it on the cap table to read as there was a pre-seed investor who got in the early concept stage, and here's why they own such a big chunk of it, because they took a huge risk. And then there is, we actually call this one the Nitwits LLC, right? So Nitwits is what we call our team here at Gitwit. And so this was the Nitwit Founders LLC. So we even actually baked into the names of those LLCs. So when you see the cap table, oh, that is a fund. Oh, that's founder. So now we need to explain that's the studio. And then you have the chunk of the cap table that is that operating team. And in our scenario, we don't always feel like that operating team needs to be the biggest thing. But if we think this is a venture that's going to go through a decent amount of dilution and go through an ABCD process versus being a more capital efficient, operate on cash flow venture, we will make that founding team the biggest thing on the cap table, and that's already starting to work well.
Yeah,
for
whether
us.
it's they're depending on the model of the studio, depending on whether the role and the timing of when the individual co-founders that are really going to stay with the startup, depending on when they came in and what role they played, it may be the biggest, it may not be the biggest, but in either case, a model that for a studio that's just a fund that creates a big dumb number for the studio of that dead capital, it hides what's the real story behind that in a way that's really problematic, and the way that it makes it so it's impossible to give the biggest stake or a big enough stake to the actual executive team at the company, or the co-founder team, or the operator team at the company. But breaking it up like this, it actually reflects the reality of you're an early co-founder that had a limited lifespan, and then you also deployed the earliest investor VC capital into this, the seed dollars into it. Those are two different line items. That makes it easier for the whole picture of the cap table to look normal.
I want to clarify the look normal thing, because now that we're on a fund two, and I've now had to raise a lot of downstream capital for our first ventures. When we say look normal, like, this is not about like trying to hide anything.
Right.
It's in fact showing a more accurate picture of what happened, because what we have found happens is we've gotten there. We've successfully raised downstream capital for multiple of the ventures out of fund one. In fact, all of them that we've attempted to, but not without significant brain damage. And not without scaring a few people off, because I think this is what happens is we're all pattern recognition machines. And if you were especially a tier one VC firm, but now there's all sorts of cottage, they're everywhere. You become pattern recognition machines. And as soon as you see something that looks and feels a little off, you're just immediately put in a little bit different bucket. Like, that's the thing that was killing me, is like, I don't want to be in that maybe bucket. Like, I need to pass that first sniff test really quickly. So it becomes really important to value.
Why don't we talk about the studio team equity compensation from it? Because this is, I mentioned earlier that this is, this is the black box on the left here, the founder equity holdco, and then those profits interest lines going up to the two circles up there. So this is right. So this founder equity holdco, what it's going to hold is it's going to hold the studio's founder stake in each of the startups that the studio incubates. So it's, if all the stakeholders here are in the U.S., we would organize that as an LLC because it's simple and efficient. So it's an LLC, and it's going to hold a founder's common share stake, common stock stake in each of these startups. That's going to be parallel to the safe or preferred portfolio that the studio fund holds. So just to pause on that for a minute, the parallel nature of those, it does a powerful thing, which is it perfectly aligns the incentives between the studio team and the investors that you brought in and you pitched on this thing. It perfectly aligns them, even better than a fund model with carried interest, because you're making money from these startups side by side from $1, and so you're incentivized. You will make money when your investors make money. Your investors will make money when you make money, and so it's perfectly aligned, the incentives there, and so that should be appealing to investors. But so what we do with this founder equity holdco entity here is it's essentially it's an equity incentive vehicle. So we're going to use that portfolio of founder shares and make incentive equity grants out to the studio team, which is the founders, the employees, advisors, whoever you want to, who you think you should incentivize to make this portfolio succeed for your investors. And we can do that in a way that is incredibly flexible from a compensation and incentive perspective, and is incredibly tax efficient. So as long as we get, in the perfect scenario, what we do is we get the profits interests. So these profits interests it's a creature under tax law that says you're going to participate in the future profits of this LLC. And so if we do everything right, we can do that pretty simply and just grant people percentages of the proceeds that come up from those common shares. We can, most people don't do this, but you can do some customization on a company by company basis, say that certain people maybe have a bigger stake in the outcomes of certain companies, but most studios, I think, rightly decide they want to have everybody share in the winnings sort of in parallel. But
for us, that was a big one. I don't want to axe a project that 4 people have been on.
Yeah.
And I don't want them to be incented to keep it alive because they're more incented.
Right.
And so other studios, may have reasons for wanting to do that. But for us, it was very much, we all need to be looking at portfolio maximization, not individual ventures.
Yeah. And I think that is the most common spirit. And I think it's a good compensation philosophy in most cases. And so the great thing about profits interests, there's a lot of great tax things about profits. And you can grant, the grants are tax-free upon grant, like options. They're kind of similar in many ways to options. And so they're tax-free upon grant. And so you're given an equity stake in the success of this portfolio of common shares in the startups, and you don't get a tax bill for it. It's super flexible in that you can design the vesting for it however you want. But then the biggest potential tax benefit is if you time everything right and design it right, which is all doable, the people who get those profits interests, they may never pay federal tax on the gains. They could theoretically make millions and millions of dollars each tax-free at the federal level, and that's because of the magic of QSBS, or qualified small business stock treatment, which is a very valuable thing in the startup and venture capital world.
Which is something that has resonated really well in this fundraise, was explaining QSBS being the greatest gift in the U.S. tax code, and how we've optimized for that, not only for our team, but for LPs as well, because QSBS is triggered on at the day that stock is created, is where the clock starts. Maybe explain QSBS really quickly, because this is a story, if you're starting a venture studio or restructuring and about to do a raise, if you're not telling the story of QSBS, it's a really powerful one. Yeah,
QSBS is a qualified small business stock, so it's a tax benefit that's that supports the really supports, for the most part, the startup ecosystem in the U.S. And it's a benefit that only applies to, in the spectrum of things, the earlier stage startups, and it only benefits the U.S. Taxpayers who own equity stakes in those startups.
And so it's I have to own equity in a C Corp that is valued at less than 50 million. Is that right?
Yeah, it's now 75 million.
Okay.
It actually got better with the recent tax changes that happened.
And it is specifically good for studios, because if you think about the clock, so QSBS has this window. You have to hold that stock for 3 years.
It's between 3 to 5 years now.
4 years, 75, and 5 years. But if you think about a typical venture fund, by the time you invest, I mean, the clock has been going for years at that point.
Right.
So, whereas with a studio,
and the company might be too big by that point,
that's right,
for QSBS to apply.
So as a studio, it is huge to optimize for because you're guaranteed are getting in below that threshold,
Mm-hmm.
and you're getting in on the day that startup was incorporated and that stock was issued.
Right.
Both LPs and that clock is starting early, so it's
Getting
specifically great for studios.
Yeah, and getting QSBS to work, it's, if you know the rules, it's not too hard to get it to work. But there's a lot of ways you can trip and break it, especially when you've got partnerships or LLCs like these triangles represent on this diagram. So that, but if you time everything right, and the timing is that through these partnerships, it just means that the profits interest holders on the studio equity side need to have their profits interests granted, papered, and tax filings made before the common stock is issued to the equity holdco. And on the LP side, on the fund side, it all works the same. The investor needs to be an investor in the fund before the fund invests in that safe. So as long as you time it that way in this context, you won't break it. And if all the other things apply, then any of your investors, like your team members, who are probably, if you're in the U.S., they're probably all going to be U.S. taxpayers. They can all benefit from it. And on the LP side, any of them who are either individual U.S. taxpayers or partnerships, whose ultimate stakeholders are individual U.S. taxpayers, they can all benefit from this. And in this sort of pooled investment vehicle model, the ceilings for benefiting from QSBS tax-free treatment at the federal level are on a company by company and investor by investor basis. And so there's not like you have to look at all of these stakeholders together and we'll max out. It's like, no, you look at for each company, for each profits interest holder or LP, that's what the caps apply. So the cap, it ends up potentially, if the portfolio, if you have multiple successful startup exits, it can be a massive, massive tax benefit.
I will say we've had multiple LPs who've never invested in studios who loved our track record, loved our story, but ultimately venture's high risk. And they looked at this and said, low probability I don't get my money returned because of all of those things that we just talked about. And QSBS was a big part of that story. And maybe we'll talk about this more when we get to the Tulsa model. But another thing is, I was listening to you talk that I'm now remembering on the fundraise part, is the trick of raising for a studio is people want you to be a fund, right? Because they understand funds, but you can't fall into that trap, because a fund manager is just somebody who deploys capital and gets compensated like somebody who gets deployed capital. Studios are builders. And if you are truly a studio where you are building the concept, you should be treated much more like a founder. Mm-hmm. And this is the other thing about this that is so hard to explain when you're just talking through the technical details, is from a storytelling perspective. The structure that we have landed on allows you to go out and explain to somebody, oh no, this isn't a 2 and 20 type thing, because that's not what this is.
Right.
And so, maybe I can articulate that better as we dive in, but that is a huge part of the art of the fundraiser around the venture studio, is trying to explain to somebody, hey, you're actually getting far more equity. We talk a lot about dollars invested per basis points of equity, and compare it to a startup, or compare it to how much equity do you investor end up with in a startup when you invest in a venture fund. That breaks the whole frame of, wait, you're taking 60% of this thing, not a 2 and 20. So that's also another thing that having this model allows you to break, is that whole idea of a fund. And I've seen other studios take a more fun type approach, and it's
right. Most people that use this kind of model, don't have the 20. They don't have the carried interest, and so that, I think that's something that, we we try to help our studio clients, really focus on pitching that to the clients. It's like, but maybe this is a good time to pivot to, when I presented this to you as a solution and we talked through it.
Yeah, that's right. I wanted the best of both worlds. If we go to the Tulsa model,
and by the way, Gitwit is based in Tulsa,
Yeah,
where we
yeah.
are sitting right now,
Yeah.
and so we decided together to give it a better name than Model B or C. It's the Tulsa model,
Yeah,
which is
right.
way cooler.
Which I think is look, we're in venture investing is happening everywhere, right? And everyone's reading, but at the same time, we're not in Silicon Valley. And we are dealing with investors who, we needed a few different features to make it marketable to them. And that's really when the incentive alignment to me was just had to be there. Both on the team side and on the LP side. But then the marketability of our studio, both to our LPs and to downstream capital, was a huge piece of this. And so what I wanted to be able to do was to go to our investors and explain, hey, you're investing in one LLC that we are all participating in, where all of the common and preferred flows up to. And then I wanted to be able to give them a capital preference. So that was something that our investors very much understood is, hey, I want my capital back first, and I want a guarantee of that before you get to share. And that is that quote fund-like model that allowed them to be more comfortable. Because you're talking about a lot of real estate investing happening around here, a ton of energy investing, and all of those have this capital return feature. And so that's what when I came to you and was like, look, I want the best of both worlds. I want to be able to split up the equity on the cap table because I need for downstream capital for that to be understood. However, for our LPs, I also need this promise that they're going to get their capital return, and then we're going to split everything common and preferred. So yeah, that's how we ended up here. So maybe you can walk us through kind of what we did here.
I think it was like a really good exercise in sort of understanding the reality of how this really should work, where we're not going to always just take a familiar pre-built model and slap it onto every situation. I mean, the Model A is not intended to be that. It's intended to be more a set of principles and structural elements that can be applied to a lot of situations. And it actually didn't quite work in this situation because
there was this comment that was floating around that same event that I was talking about earlier of if you've seen one venture studio, you've seen one venture studio. There's not a one size fits all.
Yeah, and it's exactly, we represent dozens of venture studios and they're all different. And so this was a situation where because of that investor dynamic that you were talking about, the pool of the dominant sort of characteristic of the pool of investors you were talking about is that they're not sort of Silicon Valley investors. They really can get, you had already had conversations around sort of the priority of return model, the capital, the waterfall
and
model.
Our fund one had that feature as well.
Right.
So I also felt it was going to be hard to go back to existing LPs and be like, hey, we're getting rid of that feature. Yeah.
And so, so we wanted to come up with, so I'll just say also, like the reason that a lot of people will just sort of try to slap on either an existing startup company model or an existing fund formation model is that, or a venture capital fund model is that it can be really intricate to sort of design a new model because we're thinking about all the things we talked about before and even more. We're talking about, how does this actually work as an incentive alignment structure? How does it work for all these tax benefits we want to be able to optimize for everybody? And then also, how does it work for what we end up, spitting out of here with our startups? And then we've got a whole bunch of different securities regulation issues too. We've got the, in addition to the normal kind of 1933 Act, Securities Act issues, we've got Investment Company Act issues. We want to maintain exemptions from the Investment Company Act. Then we've got Investment Advisor Act issues. around exemptions from having to register as an investment advisor, as well as things like fiduciary duties that are unique to investment advisors, in that they've got fiduciary duties under the federal securities laws and not just under state. I have to think of all those things at the same time and then try to come up with something that fits this situation. And for this, using your phrase from before, it caused some brain damage, but it actually, I did have a kind of a eureka moment where it's like, look, I can actually do this in a way that's kind of just like, in a way, this looks probably complicated on this diagram, but it's simple in the sense that all it is structurally is it's a normal venture capital fund model, which is really the same as a real estate fund model or a private equity fund model or any kind of fund model. But under the fund, there's two, in place of the, those two triangles on the far bottom left and far bottom right, those are in place of in the Model A, we had the incentive vehicle and the fund. Instead, those are the simplest LLCs in the world. They are just intermediate holding LLCs with one member, which is the fund, and they're disregarded for tax purposes. That means that the IRS, in the eyes of the IRS, they don't even exist, which simplifies your life dramatically, so it doesn't create any more tax filings. Preserves the story on the cap table of the startups that reflects the reality of what a studio does, which is, as we said before, we're going to issue some founders' common shares to one vehicle, which represents the co-founding work that the studio did. And we're going to issue the SAFE to another vehicle, and that represents the early seed dollars that you deployed into the company. But we're going to hold those in these intermediate vehicles that are very, very simple, to preserve that really important benefit on the cap table of the startups that reflects the reality of what gave rise to those stakes on the cap table, and does it in a way that makes the companies look normal to later investors.
Yeah, it's almost, if you were to draw a dotted line between the founder equity holdco and the investor equity holdco, everything below the line is a story for the operating teams and the downstream capital, because they could care less about everything. So what this does, it allows, if you're looking at these startups from the bottom up, all you see is the founder equity holdco and the investor equity holdco and the operating team. So it makes sense.
Right.
Oh, you had this co-founder in the studio, and now you have this operating team, and now you have this investment, and everything else above it is, there's no story to tell because
Right.
it doesn't exist to them. And then it gives me the same feature for these investors.
Right.
All they see is the studio fund of, oh, great, I'm in this LLC, and they can see, oh, and that's the LLC that you guys have your profits interest in, and I get my capital back. So it really gives the best of both worlds.
Yeah, for them, they've got their preferred return of capital, whether it's 1x or 1x plus a hurdle. And so they see that they've got that for like, if you've got someone who really has only invested in real estate or private equity or something else where there's a hurdle after return of capital before the studio team or the manager gets anything, they can see that there.
And then the only thing that one of the things I remember that we lost from your Model A, which I didn't care about, so it didn't, was the inability to then incentivize studio employees at the startup level. But in our model, there's a world where one of our studio employees decides they actually want to spin out with a venture. I can solve for that at the venture level at that point, right? So I can then decide what to do with their studio equity, whether that's just to go ahead and vest where they're at and stop any future, or if I think they're only going to spin out for a couple years, maybe I just continue them at the studio level. But I can now incent at the startup level. But the feature from your Model A that works better is if you do want to keep studio employees in the studio, but incentivize them specifically within different ventures, the Model A works better for that.
Yeah, it's true, because the studio equity holdco model or vehicle in Model A directly holds common stock in each of the portfolio companies. You can slice and dice sharing in the upside of those common stock holdings however you want. And so you can, if you want, design company by company equity sharing at the studio level. Like we said before, like most studios decide not to do that, even though it's kind of a nice feature to have in case you've got in case you want to sort of segregate incentives in some way. In this model, you can't, like in a venture capital fund, you can't really do that, but just because of the way the waterfall works with the return of capital and the way that the upside for the studio in the profits interest that the studio side gets, it's not ultimately calculated on a company by company basis. It's on a portfolio. It's derived from the portfolio, and you can't really undo that math.
Another thing that that I think was a non-negotiable for us and should be for any studio, and I've now talked to multiple studios who are having to figure out how to unwind and do this, is making sure the studio operations is its own entity that is owned by, like, no one gets to touch that. Right. And for us, that was really important. We've been building this thing for over 15 years, right? And it's only now become the quote venture studio, but I was not trying to have LPs have a stake in the thing that we had been building, which is the engine that creates this. And so having that be its own entity that then gets to manage this was a feature that in your original white paper, solved for that regardless of the model, like you said, there's not a one size fits all. That to me feels like it's a feature that should persist for most. Yeah.
That aspect of sort of dealing with, investors who are new to the venture studio model can be pretty difficult, and it's a bit of a messy area of sort of selling, storytelling, and negotiation that we engage in a lot. It's related to in the venture capital fund world. It's really emerged over the last handful of years that you more often see anchor investors wanting a GP stake as well as an LP stake. And so that sort of bleeds over into this. We see that a lot. I think it also comes out of the fact that a lot of the, most of the people who I think are starting studios really are operators and company builders first. And so they speak the language of, I'm building companies and I want you to invest in those companies. And the investor hears, well, that's going to be a lot like investing in a startup that you're creating. And then this is, if a studio ends up with a corporate lawyer, a startup lawyer, they might be given a structure that looks like investing in a startup. Problem is that that doesn't almost never works well. You in part because you don't want it to be a corporation at that level, because it's going to be super tax inefficient if you do that. In other words, you're going to be gifting lots of money to the IRS that you didn't have to, that you could have kept for yourselves. And then if you're going to be doing partnerships or LLCs, and you're going to be potentially stacking in your investors all into the same mothership over and over on top of each other, you're going to end up with a nightmare, and you're going to be giving up more and more of the mothership. In these models that we try to help studio founders use, they do have the LPs come into a portfolio specific entity like a fund, and we think that is what makes most sense. And and if you pitch it right, the investors should get it right. But it's not the easiest thing to to get right when you pitch it.
We've stubbed our toe a few times on that. Yeah, as we get to kind of the last chapter of this. Yeah. Any questions for me that you think other studio operators would find valuable?
Yeah, absolutely. So we've talked about, designing the structure, and then so the happy ending to this story is it worked. You raised money. You raised a good amount of money, and now like any studio, it's time to start building companies. So that's it's every studio again is different in how they approach that, and so I'd love to hear you talk a little bit about like how once you've raised capital and you're ready to start doing this. Tell me a bit about like what is the Gitwit method?
Yeah, so we're really heavily focused in the applied AI side of things. And for us, that means getting deep into the weeds of an operation of a company. And it's kind of the history of Gitwit has been founded on, so co-founder's got a PhD in consumer behavior and has really been kind of an innovator in research methodology, specifically a form of research called ethnographic research, which is just a fancy way of saying getting into the world and observing humans and their behavior, which in the world of applied AI, where you're really kind of this cognitive industrial revolution, you're trying to get machines to do cognitive work. You've got to figure out what are the decisions and the workflows and how does that happen, right? It doesn't happen on a whiteboard. It doesn't happen in the studio. So a lot of our methodology is getting into the world and exploring. So that's the stuff where we would be using our investors' money directly, like at the studio level to go do the research. And then as soon as we have a concept, that's when we'll spin up a C Corp, right? And this is one of the things that you did a good job of coaching us on is that story needs to be told along the way. So that's when we'll switch to now taking our studio funds, investing them into that C Corp, and then just charging back because we haven't hired a team yet. And so this is the cleanliness of this is just works magically for us because we can tell that story. We can issue the safe note and we can explain what was still
at that
us
stage.
doing
I
the work.
like to call these virtual portfolio companies because they're still just run on an outsource model by the studio.
Yeah, that's right. So fully in-house. So we'll put a venture leader on this at this point. And so a venture leader is somebody who has to have some level of product management, product sensibility, but also more of a generalist, kind of a general manager who can do everything from work with your team on the legal and the contractual side to dealing with the first customer. So we've got somebody internal who's the quarterback. This is kind of pre us really going all in on something. So now you're into this concept stage where we're doing a lot of validation of, okay, we found a problem worth solving inside this, big property and casualty insurance firm or home health care or inside psychologists, 3 areas where we already have portfolio companies. And we'll typically embed for a while there after there's a concept, some level of validation. Sometimes that's like message market fit. Let's put together a pitch deck. Let's really get an understanding. Sometimes that's much more, let's prototype as a more technical feasibility issue. And then once we're at a point where we've got the signals that we need, sometimes that signal is we have a customer that has committed. That's when we then start really forming the founding team. And so really for us, it's a game of how do you get deeply embedded with these companies. And that's another area where we've worked with some of your startup partners is designing a design partner program. Because so now you're going and knocking on somebody's door saying, hey, I really want to go explore, but it's because I want to build a software that I want to sell to you and all your competitors, right? So there's this.
Yeah, these design partnership models are really interesting.
Yeah, so that's been our key. So we brought in another partner who this has been his brainchild, and him working with your team on this was, how do I come with a framework that allows me to go knock on the door and say, hey, we'd love to doing this deep research is pretty invasive, right? This isn't just let's do a stakeholder and whiteboard session and come up with an idea. This is, we're going to go follow the people on the ground for a while, talk to the managers. We're just going to start pulling on the thread and see where it goes. And so we came up with this mechanism where we say, look, and if we find something, and if you become a customer of this thing, you like this thing that we find, you're going to get, single digit percentage common shares in this, founding shares in this venture. And there's a feature in there where they have to stay a customer for X amount of time. And then we'll actually give them the right to invest at a early valuation. So basically what we'll say is, hey, now that we found this and you like this thing, pre us starting to invest even more money in build, you can now invest up to $1 million, $1.5 million, $2 million at a really favorable valuation. Now we only let them do that if they do that right up front. Because now if we start building and we de-risk this even further, the price needs to go up. And that's done two things for us. One, it just allows us to get in because it gives them the promise of, if I like this, I'm going to get a swing at it. So that's the feature we're really solving for. But it also, if we look at kind of go back to the formula we were talking about before of just dollars invested per basis points of equity, it makes us far more capital efficient because now we're bringing in early outside capital and we can deploy more of our capital to go finding more things. So that's kind of the general approach that we've been taking.
Yeah, hearing all that really emphasizes something that I've seen as someone who's had a deep visibility across the venture studio market over that past 4 or 5 years that I described earlier, which is when it first started emerging a couple years ago, there were a lot of people trying to get into venture studios, kind of in part because I think it looked like a new shiny thing that might attract investors, because it was new. Not that that's like any kind of compelling pitch, but that seemed to be motivating a lot of people. But what I've seen over the last year or two is that there's a lot more sophisticated, mature, experienced studio founders coming in to the market, and we're seeing, and I think Gitwit is a perfect example of that. A team that's approaching this not out of the blue, but as a pivot from a business model that you've been pursuing and a service model that a company service model that you've been pursuing for many years,
right.
But pivoting into using the venture studio model to really leverage that into something new and exciting.
Yeah, it's getting those two things to click, right? It's the building the operational competency of being incredible at 0 to 1, but then having a business model that makes sense for that and allows you to build something that is scalable. I guess as we're getting to the end here, as somebody who is probably the most prolific studio designer in the field today, and at a firm who then represents more successful startups than any other firm. If I'm watching this and I'm either thinking about starting my first venture studio or maybe in a path like I was of, okay, I've started to tinker around this, but now I need to nail the structure that sets us up for the next decade or two. Yeah, what questions should I be asking myself if I'm that potential studio founder?
Yeah, there's a lot, but as you can see from all we've talked about, there's a lot here. There's fundraising, there's internal team, there's networks of external teams. I mean, I think those are the kind of in a way you could say there's like 3 things you really have to have pretty much ready even before you want to talk to somebody like me and figure out exactly how to build this thing from a legal perspective. You really have to already have a network of potential investors who you are pretty sure are going to be comfortable investing in the next thing you do. You're also going to have to have a network and a pipeline of co-founders or executives, hired executives that come in to build these companies. You're not going to be able to, one thing that's going to, really get in the way. You're not going to be able to raise money if you don't already have, some potential investors. And you have to remember, I think, and you and I have talked about this before, that fundamental to a studio is it's not a single startup model. You need to structurally be ready to spin out multiple companies. Well, it doesn't have to be 100 a year. You have to think about the kind of, what your capacity is. Like if you're just a couple of people, and you're not going to be able to do more than one company. So you have to have all those networks and pipelines and things all set up and, ready before you even want to go, figure out exactly how to set it up. But once you've got those things, we have, flexible ways to optimize how to set it up.
I'd say for me, I wish I would have reached out to you earlier, because I think what I learned is I was able to, in a few conversations, and I remember when I was on the professional service side, I always used to, I wish you would have called me a bit earlier, because I was able to, in a few conversations, get my head wrapped around, because I did have, some investors who I knew were going to come along for the next one. But I was able to, into a handful of conversations, get myself to a point where I'm like, okay, got you. Now I can really go nail this story. And we hadn't even done all the work yet, right? Like do like a small deposit with you. And then after that, I can just kick it all to the closing of the fund. So to me, I wish I would have reached out earlier, had a few of those exploratory conversations where we started to really understand where we're going, because then I could get back to fundraising and then worry about all the details of really nailing everything after I had kind of that first group of committed investors. So
yeah, I think that's a good point. That coming in early can get you earlier on in a position that you've got, how to pitch the story, because you do really have to be, really have to be thoughtful about how you explain what you're doing to investors to keep them focused, not just to keep them focused on what they should be focused on, but keep them focused on what they should be excited about investing in. There's real pitfalls in failing to do that here. And I can help with that, but I know, we're expensive. And so people are wary of coming in early, but as you sort of hinted at, in many cases, we are willing to work with people to defer the bulk of our legal fees until you've actually raised money. And so we've got flexible models for that. So
there was also the for me, being able to tell our investors, like, hey, we're using somebody who has designed many successful studios, and what we're doing is market. So to me, there was our first one had been done by a firm who just not had experience in studios. So there's also this feeling of investors of invest in something new. Then they want to know, what are you doing and what is this strange structure? So it's nice to be able to then even point. We actually put your white paper in our data room. Or like, hey, if you want to go learn more about why. So how many people of our investors have read that? I know one. So
yeah, well, a lot of people have read it, and we'll I think when we post this thing, we'll make sure there's a link to that for anybody who wants to read it.
Well, man, thanks for taking the trip down to Tulsa from Seattle to come chat about this. It's been kind of fun to unpack the story of getting here. I'm in the most fun part of this now, which is, I actually really enjoyed the process of unpacking this, because I knew I needed to not just have the structure right, I needed to understand it for our employees, for our teams, for our investors. So it's actually, intellectually, is actually a pretty fun process. But yeah, now that we've done a close and we've been kind of heads down for the last 60 days, it's running a studio is fun.
This is great. It's been great to come in here and see your space, see the space that you've got for your, companies in the early stages, and to visit Tulsa. And proud to name this model after the city. It's a cool place.
Yeah, very good. Appreciate it, Byron.
All right.
Come all you old-time cowboys and listen to my song. Please do not grow weary. I'll not detain you long concerning some wild cowboys